All right, welcome everyone. Welcome to it is not the Hurley Markets commentary. This is the trade findings and adjustments for Thursday the 4th. Tomorrow, I'm going to be 51. Boy, does time go by fast. That's all I'm going to say. But we've got a couple things that I felt were important for you guys to know about before we went going. Well, it's just, this is going to be a little lesson on trading. And here's the first thing that I brought up. If we're looking for instant gratification, not an investment process, what is it? What is it if we're just looking for that instant gratification, not an investment process? Okay, that is good. I like that one, Mary. It's day trading, which is very difficult because you can't be wrong. Oh, and Lance, I agree. It's gambling. I never thought of that. I was going with the day trading. But yes, it's gambling. If you are looking for instant gratification in your portfolio, then truly you are gambling. I wasn't thinking it that way. That's pretty amazing that you came up with that. But it's gambling. The market moves too quickly. It's all luck. There is no investment process if you're trading on a 1, 2, 5, 10, 20, 1 hour increments. There's no time for repetition to occur, so you're gambling. It's an investment process. An investment process means it will take some time to achieve, boy, can't spell, the desired results. And that's just the way it is. There's no ands, ifs, ands, or buts about it. And sometimes we forget that. In fact, sometimes some of the biggest mistakes are not waiting long, can't spell, enough. Where we don't wait long enough for our research to come to pass. Because sometimes our research is way before the move. News interrupts it. Earnings interrupts it. War interrupts it. Elections interrupt it. Weather interrupts it. I can keep going. There are a ton. There are an absolute ton of reasons why things might not work the way that they're supposed to. Yes, I will type that in. Upgrades / downgrades. Yeah, I mean, let's face it. Our markets are manipulated. They are. Bad news is I kind of feel like our elections are getting manipulated, right? But our markets are manipulated. Manipulated by the Fed, by institutional traders, by companies themselves, by brokerage firms, why you should never be with Robinhood, they trade against you. I mean, this is just the understanding. And why is it important? Well, it's important because today our stock market sucks, right? Today our stock market is down a percentage point. So a lot of people ask me, well, Kevin, you're a stock picker. In fact, I've had some rude comments. You're a stock jockey. You're a piece of stock jockey horse going north that comes out of it south. I mean, I've heard them all, right? You're a stock jockey. I disagree. You can't beat the market if you're in the market and you're charging someone. You can't beat the market if you are the market. And it's pretty neat because on days like today, on days like today, we're beating the market by 1%. In fact, let's go ahead and let's update it so it's more up to date. Hey, we gained another $1,000, beating it by 1.03%. We're doing really good. The stock market never increases by hundreds of percents, but stocks do it all the time. There are times your stocks will not move like you want them to move. That is just the way things go, which means you have to think about where you're going and why. Which brings us to our second comment. FOMC, market meaning. Raise 0.25% or 25 basis points, right? So what does that mean? I'm going to ask you guys first. What does that mean? So yes, things are more expensive, but it's not things per se because this is supposed to combat inflation. Borrowing money is more expensive. But what does this mean? You guys are quiet. You're crickets right now. If you don't know, type a couple question marks in there. But this is what was moving our markets yesterday and why we turned negative. It was rather important. There we go. 3 of you just typed in question marks. So what it means, it all depends on the aftermarket comments from Powell. Probably another couple of quarter point rate hikes, but they are closer to the end than they were yesterday. So he did say that they're getting close to the point where they're going to take a pause. Didn't say how close they were, but they're close to a point where they're going to take a pause. And that pause will be our catalyst, right? That pause will be our catalyst. into the future. But the Fed always overshoots. And there's something else they said, very simple. They will not plan on cutting rates in 2023. So with that, what can make money? Companies that don't need to borrow, or companies that make money off of borrowing money. Banks, credit card companies, big tech, who has huge cash piles. That's what's going to be moving our market. That's where you're looking at positions in the market. If it were me, I think we need time into next year, and I also would want a hedge. What we do is we hedge, something you don't get in direct stock ownership and day trading and futures, commodities. We want hedges. Leap, bull call positions are where I would be looking to place some trades. Those trades are going to be in banks, credit card companies, big tech who has cash piles. We talked about it last week. The Meta, June 2024, 240, 300. It was and is a great position to be in. Kevin, what do you mean? Well, let's see if we can find the individual positions. We can. Boy, I wish we had a better way to see where this was at, but I'm just going to use this individual position here so that we can break it down where it's at today, because it's rather important to understand where we would go and why, and it's important for you to understand these positions. So if I can just go to webinar out of my way. Let me get a couple little screenshots here. You know what? I gotta. This is just prideful for me. I got a point where we're at today. Yeah. Down market, down 1%. We should be down 150K. We're not. Love it. Good positions. One more. Let's just snap Meta Platforms. Wow, what an amazing day this is today. All right. Leap bull call positions. Let's talk about leap bull calls. Are a long call, which is the right to buy the stock at a certain price for a certain period of time. It is a stock replacement position. The second position is a short call, which is the right to, which is the obligation to sell a stock at a certain price for a certain period of time. In this case, it's buy. Actually, let's go to Meta here. It is between now and June 2024. Boy, I cannot screw up typing. Son of a gun. And the third Friday of June 2024, we have the right to buy Meta at 240 bucks. And between now and June 2024, we could be obligated to sell at 300. So that's the position we're in. If we are looking at that, that is exactly where we would be. Let's break this down on how this is going to work. Give me a quick second here. Need to pick up those pictures. And we're going to work those real numbers off today. So here we go. Boy, we've got almost 20 people in. Maximum profit. And I'm going to say from buy/sell prices is what? What is the maximum profit between these buy and sell prices? Come on, what do you guys? I'm going to make you think. What is the buy and sell prices? Jim, I'm going to ask you. Lance, I'm going to ask you. What's the maximum profit between these buy and sell prices? Any idea? There you guys both typed in 60 bucks. Exactly. You buy at 240. You sell at 300. It's 60 bucks, right? Now, if we were just to take the prices, which are right here, that's your maximum profit. In real life, You have to take out the cost basis, which we bought the longs for 55.45. We sold the shorts for 33. If I do my math, cost basis is 55.45 minus 33.05, which equals $22.40. So the real max profit, right? 60 minus $22.40, which I'm going to use a calculator so I don't ever get it wrong, is $37.60. You take that and you divide it by your $22.40. You have a return on investment of 167%. You can make what you put it, what you risked, plus another 67%. Over 1.5 times risk to reward. But here is something that is absolutely amazing in this position. Today, we're making $730 on the long position. We're making money there. But we're also making money on the short position, $805. And this is where you guys are going to tell me, Kevin, that's a loss. So let me help you understand really quickly. And I'm going to use this number. If you sell something to someone, right? If you sell me a car for $76,000, I'm going to say for $77,000, right? If you sell me a car for $77,000 and you can buy it back 2 days later for $76,000, how much money have you made or lost? If you can sell me a car for $77,000 and the next day buy it back for $76,000, how much money have you made or lost? Perfect, right. If you give me 77 and then I give you back 76 the next day, excuse me, if you sold to me, right? If I gave you $77,000 and I buy it back the next day for 76, I'm going to make $1,000. This is the hedge in the trade. We've lowered the risk of our purchase price of 55. We've lowered it by 60% by selling the position. We have it hedged. We're hedged. If I was looking at new positions into the future with the uncertainty, I'd want to hedge. If we have a couple more interest rates before they say, hey, things are going to take off, I want to be hedged. Apple has earnings today. It'll be interesting to see where Apple goes. Square has earnings today. It should make great money in this higher interest rate environment. This is what you're looking at when you trade a process versus a just throwing money in the market and hoping it makes money, right? That's not what we're doing. This is where you need to be using some time, some education, by doing your homework to find these opportunities that are cash rich. Are there any questions for me today? Are there any questions you guys have that I can help you with? If not, guys, I want you to have a great rest of the week. I will see you on Monday. Yes, Lance. If I was looking at new positions, I would be doing this in like JP Morgan and Apple and Square. This is where I'd be looking to find some opportunity. Bank situation. So good. Banks are good in general. What's not good are regional banks. And Jamie Dimon went so far as to say, hey, it's kind of taken care of. He bought the last one that he thinks is in trouble. I think they're going to be more. There's certain regions like Illinois, Chicago area that are going to get hit. There are areas with low income that have been selling homes with the recession coming in that are going to get hit. The bigger banks look like they're fine. They paid attention. They got out of longer term. They were smart. They did what they had to do. So I think we're going to be okay in that regard. It's just the regional banks. We still will probably have a couple smaller ones, and you're going to pick and choose the areas. What I really would tell you is think and consider what you might call some of the armpits of America right now. Inner city Houston looks awful. Chicago looks awful. Detroit still looks awful. There are some areas where regional banks have had loans in those areas where they weren't thinking quick enough and they are in trouble. So those are areas that you might see some weakness in regional banks, and it would be really smart to it would be really smart to have either protection on or to be expecting those regional banks with loans in those areas to fall pretty good. Just something that you should pay attention to. Jim, does that answer your question? And Lance, does that answer your question? Mary, you're pretty quiet today. Any questions, Mary, that I can answer for you? Or at least try to answer for you? All right, guys. Hey, you guys have a wonderful evening. I'm trying to stall here for Mary. You guys have a wonderful day. And I will see you guys next Monday. All right, Mary. Perfect. All right, guys. Hey, pleasure being with you. We'll see you next Monday. Have a great day. Bye-bye.